Good afternoon and welcome to Bulls, Bears, and the Bell. Thank you for joining us. We are taking the fire hose of market intelligence and distilling it down to the essential, targeted insights. Welcome to the deep dive.
It's great to be here.
Oh,
And yeah, an important day to really dig into. Today, we are absolutely unpacking a fascinating stack of market sources.
we are.
We've got this highly detailed daily market and futures summary,
Mm-hmm.
and it captures a moment of pretty dramatic divergence on Wall Street.
Yeah.
We're looking squarely at Tuesday, October 21st, 2025,
Right.
a day when the market narrative was pulled in two very distinct, almost contradictory directions,
Exactly. Our source material paints a vivid picture. On one side, you've got corporate good news really battling hard against some deep systemic macroeconomic uncertainty.
Yeah, that's the core tension.
And then on the other side, the whole scene is kind of amplified by this critical and I think potentially dangerous information vacuum coming out of Washington. So our mission today is simple. We want to give you the shortcut to understanding the precise mechanics behind the Dow Jones Industrial Average hitting an all-time record high.
While the NASDAQ didn't.
While the tech-centric NASDAQ composite paused, yeah. And maybe more importantly, what enormous structural macro risk is looming just days away on Friday.
That's right. The core conflict driving the market right now is really this narrative. Earnings trumping macro. We saw the Dow soar to an all-time peak,
Amazing numbers.
driven almost entirely by powerful Q3 corporate results, those reliable, consumer-facing blue-chip names. It feels like fundamental strength overriding that general pessimism we've seen.
But that optimism, it was highly selective, wasn't it? I mean, that surge in the Dow sounds fantastic, but, the Dow's generally less sensitive to long-term rate expectations than the NASDAQ.
True.
So I have to ask, isn't that record high maybe actually a sign of fragility rather than broad strength? Does it just tell us where the money fled to when the macro picture got murky?
That's a really critical observation. And what's truly fascinating here is that the tech-centric NASDAQ composite actually retreated slightly.
Just a bit, yeah.
It wasn't a universal buying spree at all. That NASDAQ pause, it signals a clear, pretty intentional rotation away from those long-duration growth stories that dominated earlier this year.
Companies really sensitive to rates.
Exactly. Companies whose valuations rely heavily on low future discount rates. And it signals a definitive shift toward tangible value and, demonstrated near-term profitability. It suggests investors are hedging their bets.
Hedging against higher for longer rates, basically.
Precisely. Against the very real possibility of that.
So today we're going to break down exactly which companies provided the concrete fuel for that Dow record. We'll look at what the continued decline in the fear gauge really means when it hits such low levels.
That VIX drop was significant.
Yeah. And why a single critical data point this Friday, that September inflation report, could just instantly unravel the entire current rally. It is a precarious tightrope walk for investors right now. And you need to know where the next gust of wind is coming from.
Quite. Let's start by detailing the hard numbers. They really illustrate this headline divergence. It was one of those days where if you only looked at the S&P 500,
You missed the story.
you'd totally mask the real turbulent story brewing right beneath the surface.
Absolutely. So if we detail the key metrics for Tuesday, October 21st, the performance split is just undeniable. The Dow Jones Industrial Average, the DJI, closed at a record high,
Yeah.
advanced approximately 300 points, that's up 0.6%, and the driver. Strong earnings from industrial, manufacturing, general consumer-facing blue chips.
And, in stark contrast, the NASDAQ composite ended slightly lower, retreated 0.1%.
Right.
Like we said, not panic selling, but definitely a calculated consolidation in the high-flying tech sector.
Yeah.
Especially after that big Apple momentum from the prior session. The broader S&P 500, it managed a modest gain, finished up 0.1%, but really it was largely pulled along by the heavyweight strength of those Dow components.
So the primary upside story was very micro, wasn't it? Driven by corporate fundamentals.
Totally.
Positive corporate results, optimistic forward guidance, those were the overwhelming primary market drivers. They successfully overshadowed those persistent macro uncertainties. It's a very unusual dynamic where company-specific news just dominates the entire tape.
And we can't forget the sort of underlying macro hopes that provided an essential safety net,
Right.
even if they weren't the direct drivers of where the money was flowing.
Good point.
Investor sentiment did get a bit of a boost from optimism about a potential end to that 21-day U.S. government shutdown.
Right. The shutdown's been hanging over everything.
Exactly. And our sources noted a top White House advisor predicted the budget impasse could be resolved this very week. Now, this doesn't fix the data problem we mentioned,
No, definitely not.
but it's a welcome relief for policy stability and just general market noise.
Sure. And on the credit front, investors seem to just keep brushing aside worries about systemic risk from the regional banking sector.
Yeah, that fear seems to have faded. For now, at least.
They seem to be interpreting those challenges, which were a huge worry earlier in the year, as kind of isolated issues, specific to certain institutions, not a sign of broader instability.
And that confidence was also helped by some solid reports coming in from several regional lenders themselves. It really shifted the market's attention away from credit fears and boom, right back towards earnings strength.
Okay, that generally positive environment, it has to contend with what our sources are calling the structural risk of the moment, this critical information vacuum.
This is huge.
Yeah.
If we connect this to the bigger picture, that ongoing government shutdown has created a really profound data void.
Yeah.
We're missing key government economic reports, retail sales, factory orders, consumer confidence indices.
The usual stuff we rely on.
Right. Which forces market participants to rely far more heavily on corporate commentary, CEO sentiment, anecdotal evidence. It's almost like trading on vibes rather than facts.
So in this environment, companies like, say, General Motors or Coca-Cola, they essentially become a temporary, kind of imperfect proxy for the entire U.S. consumer and global health.
That's exactly it.
Their guidance is treated as gospel because there's just no official data to refute it right now.
Precisely. And the implication of that reliance is massive. It significantly elevates the potential for volatility when the official figures are eventually released.
Okay.
Because that delayed data, if it tells a different story than the rosy picture painted by Q3 earnings, it could trigger a sharp, sudden repricing. The market has no anchor of verifiable fact right now.
The unknown is always scarier than the known.
Always.
But ironically, the market's measured anxiety level, the VIX, it seems to reflect the positive corporate story, not the uncertainty.
Yeah, the VIX continued to ease dramatically. It fell sharply by 12.3% on Monday, dropping down to 18.23.
18.23.
That VIX reading is really crucial context here. It's significantly below the historical long-term average, which usually hovers closer to, 20 or 21?
Right.
Hitting 18.23 tells us that near-term anxiety isn't just receding, it's practically dormant. The market feels comfortable, focusing only on that short-term earnings momentum.
But like you suggested, this calmness might be a bit artificial, right?
Yeah.
If it's based purely on optimistic corporate sentiment rather than verified economic fact.
That's the risk. It could be a calm before a storm.
And that low volatility pairs perfectly with the Treasury signal. The 10-year Treasury yield hovered near a 6-month low at 3.96%. What does a yield that low tell us about the market's collective psychology regarding the Fed?
Oh, it tells us everything. When long-term yields drop to a 6-month low, like 3.96%, it reflects persistent, really aggressive market expectations for Federal Reserve easing.
Rate cuts.
Rate cuts. In fact, the market is currently pricing in 2 more rate cuts by the end of the year.
Wow, 2 more.
Yeah. And this low-rate environment is critical because it fuels higher valuation multiples for stocks, especially those rate-sensitive growth stocks, right?
Yeah.
Future cash flows get discounted less aggressively. But again, this entire structure, the low VIX, the low yield, the record Dow, it's all built on the expectation of Fed cuts, an expectation that Friday's inflation data could immediately challenge or, outright destroy.
Okay, let's unpack this and get into the specifics then. We've established the market's record high was built on specific companies' strength. We really need to detail the standout performers because they are the foundation of this current rally. This section is all about analyzing that corporate resilience, the operational strength we saw.
Yeah, the pre-bell earnings show on Tuesday was genuinely impressive, particularly because the companies that reported are such large, influential bellwethers of consumer and industrial health.
Right, the big names.
Their results largely exceeded analyst expectations, and they really set a tone of confidence that, frankly, the market was desperate to adopt.
And the undisputed standout, the real engine of the Dow's advance that day, was General Motors, GM. This stock soared 16%. 16%, leading the entire S&P 500 index. You just don't see moves like that without massive fundamental operational surprises. Let's break down those numbers, and maybe more importantly, the strategic insight they offer.
The numbers were spectacular. GM reported earnings per share of $2.80.
$2.80. Okay.
And to provide crucial context, the consensus estimate ranged pretty narrowly between $2.19 and
Well,
$2.32.
they crushed it.
They absolutely smashed that consensus by a margin of nearly 20%. And revenue also surpassed expectations, coming in at $48.59 billion against a forecast of around $45 billion.
Wow.
This speaks not just to volume, but to the efficiency of their operations, too.
But the most crucial insight here isn't just looking back, right? It's the forward-looking sentiment provided by management. GM raised its full year 2025 guidance. Why is that action considered gold right now?
Well, in a high inflation, high uncertainty environment like this one, the ability to raise guidance is probably the single most valuable characteristic a company can demonstrate. It underscores strong operational strength, obviously, but most critically, it gives investors concrete evidence of pricing power.
Ah, the magic words, pricing power.
Exactly. This means GM is successfully managing its own rising input costs, labor, raw materials, you name it, and at the same time, successfully passing those costs on to the consumer without sacrificing unit demand.
That's key.
That ability to dictate pricing terms differentiates them dramatically from companies maybe getting trapped by margin compression. That's why the stock reacted so violently. GM is essentially telling the market, hey, the consumer's healthy enough to absorb higher prices, and our operations are nimble enough to capitalize on it.
Makes sense. And GM wasn't alone in fueling the Dow's advance, right? We saw strong, consistent reports from other blue chip components too, illustrating a kind of broad base of resilience within those value sectors.
We certainly did. Industrial conglomerate 3M, ticker MMM, reported EPS of $2.19. That comfortably beat the $2.07 consensus, and their stock rose about 6%. Their success points to maybe the stabilizing global industrial supply chain and perhaps the success of their ongoing restructuring efforts, simplifying operations, getting rid of underperforming segments.
Okay. And the global consumer giant, Coca-Cola, KO.
Coke topped estimates, too. EPS of $10.82 versus a consensus of 78 cents. That led to a respectable gain of about 4% in stock price.
Right.
So when you have these three giants, an auto manufacturer, a diversified industrial, and a global consumer brand, all beating expectations and confidently projecting strength,
Yeah, you get a record Dow.
you get a perfect storm for a record high Dow. Their results act as a stabilizing counterweight to the Nasdaq's more, let's say, speculative nature right now.
However, we also saw interesting results coming out of energy and defense sectors, which provided a more mixed picture, didn't they? Showed that even among bellwethers, investors are being highly selective.
Very selective. Let's detail that. Energy services provider Halliburton, HAL, reported a strong beat. EPS $2.58 versus a $1.50 consensus. That led to a jump of over 9% in shares.
Wow, over 9% for Halliburton.
Yeah, suggests activity and pricing in the energy services sector are pretty robust, responding well to global demand.
Okay, but then defense was less cohesive.
Yeah, far less. Lockheed Martin, LMT, they beat earnings expectations and raised guidance, usually the double whammy investors crave.
Right.
Yet it saw only a modest gain of about 1.00%. It seems the market might have largely priced in geopolitical strength for the defense sector already.
Okay, maybe expectations were already high there.
Could be. And then the clear underperformer was Northrop Grumman, NOC. It reported a mixed quarter profit beat expectations, but quarterly sales missed the consensus forecast.
Ah, the top line miss.
Exactly. And that led to a 1.75% dip pre-market. This divergence really shows that investors are scrutinizing revenue quality and growth metrics far more closely than just margin protection. If you miss on the top line, the market is instantly punitive, even if profits were managed well.
Got it.
And this brings us right back to what we identified earlier as the proxy problem.
Right.
The resounding strength of bellwethers like GM is being interpreted as this profound positive signal about broader consumer demand and overall economic health.
Particularly because we have no official data telling us otherwise.
Exactly. It is the proxy for the economy right now, precisely because the official government data is shut off. When forward-looking guidance from major corporations is the primary source of economic insight, any optimism they project gets magnified across the entire market.
This raises an important question then, one that you, the listener, should constantly be asking. Is this corporate optimism built purely on Q3 strength, maybe out of sync with the underlying reality that the delayed government data will eventually reveal?
That's the million-dollar question.
The market's currently accepting corporate guidance as gospel, but if the CPI or future employment reports come in weak, that corporate confidence could be instantly undermined.
Totally. The Dow is celebrating the micro. The Nasdaq is still waiting anxiously for the macro shoe to drop. So moving away from just individual company reports for a moment, the broader capital flows across sectors, they tell a very clear analytical story about investor confidence, or maybe, perhaps more accurately, about risk mitigation.
Yeah.
We're seeing a distinct, clear, rotational story in action. Capital shifting from future promise to current performance.
Yes, the market isn't just rising uniformly, it's aggressively shifting. Cyclical sectors led the way, reinforcing the Dow's strength and kind of validating the idea that companies tied directly to the economic cycle are seeing renewed investor favor.
That's right. We saw materials, XLB, industrials, like LLA, and financials, XLF, each posting strong advances, consistently around 1.2% in the prior session.
Okay.
This leadership from cyclical and value-oriented segments is highly strategic. It indicates investors are intentionally allocating capital to areas showing robust, tangible, near-term profitability that can, withstand high interest rates. This is the value preference in action.
So companies that do well when the economy's chugging along, or at least stable.
Exactly. And crucially, they have less sensitivity to those long-term discount rates that just crush growth stock valuations when the cost of capital rises.
Right. And we saw the inverse of that with defensive lagging. The consumer staples sector, XLP, actually fell slightly on Monday. Why is that significant?
Well, a lag in defensives is a classic signal of clear risk-on sentiment. Usually,
yeah.
Investors move into staples, pink packaged food, household goods, when they're uncertain about the future economic outlook. So when they stop flocking there and instead move into riskier industrials and materials, it generally means they feel comfortable taking bigger risks elsewhere, betting on economic growth continuing. However, given the looming CPI data, this risk-on move could also be interpreted maybe more tactically, a move into sectors that offer a better inflation hedge than pure technology stocks, perhaps.
Interesting angle. So not just pure optimism, maybe a strategic inflation play too.
Could be part of it. And that risk reallocation led directly to tech consolidation. That slight decline in the Nasdaq wasn't really a failure, more like a tactical pause.
Right.
It suggests investors are taking some profits in those high-flying tech names and reallocating that capital right into the proven earners like GM and 3M we just talked about.
Makes sense.
It's a clear case of value being prioritized over pure growth,
Yeah.
especially right before a huge interest rate risk event like the CPI report.
Okay. We should mention, though, even with the Nasdaq pausing, the Apple effect kind of provided an essential foundation of confidence, didn't it?
Oh, absolutely. Apple's stock had surged nearly 4% in the prior session,
4%.
bringing its market cap near an astronomical $4 trillion,
Hmm.
driven by strong reports on the new iPhone 17 sales cycle.
Incredible.
That stability in the largest tech name really prevented the consolidation from turning into a broader rout, and it maintained an underlying narrative of consumer resilience, at least for high-end products.
That consumer resilience is vital, but here's where it gets really interesting, I think. The warning signs that the public market seems to be choosing to ignore right now.
Ah, yes.
We have to dedicate some serious time to the private credit warning. This feels like an absolutely crucial, underappreciated risk our sources flagged.
This is a classic example of, looking for your lost keys under the streetlight, even though you lost them in the dark alley.
Huh. Good analogy.
The market is celebrating the easing of regional bank credit fears in the public sector. The problem it can see clearly. But some strategists are pointing to potential and growing stress in the less transparent private credit markets.
Okay, for our listeners, let's maybe illuminate this darker corner a bit. What exactly is private credit and why is it so opaque compared to bank lending?
Sure. Private credit essentially involves direct loans made by investment funds, not regulated commercial banks, to mid-sized and sometimes even larger corporations.
Okay, so non-bank lending.
Exactly. It ballooned in popularity precisely because it avoids the strict regulatory scrutiny banks face post-2008. Because the debt is held privately by funds, often structured as leveraged loans or mezzanine debt, there's virtually no centralized reporting or transparency into the true health of the underlying borrowers.
Wow, okay. So very little visibility.
Very little. Institutional investors, especially large pension funds and endowments, they're heavily exposed to this space because it offers higher yields than traditional bonds.
Right, chasing yield.
Always.
So the warning is that defaults have been rising in this opaque space, and high-yield spreads are expected to widen. Why is that a systemic risk? Why could that reignite the market's sort of forgotten fears?
Well, if defaults continue to mount, those private funds holding the loans, they face losses. If the pension funds that invested in those loans start reporting impaired assets, the ripple effect could move rapidly through institutional finance.
Ah, the interconnectedness.
Exactly. It's a potential silent contagion because the public market won't see the stress until a major fund or institution is forced to liquidate other assets like publicly traded equities, for example, to meet redemptions or shore up their balance sheets.
Right, so the problem spills over from the private side to the public side unexpectedly.
Precisely. The market thinks the credit crisis is over, but it might just be waiting in a corner where the public data doesn't reach. It's a critical, underappreciated risk that runs completely contrary to the VIX's current state of complacency.
Very sobering thought there. Okay, so as Tuesday's trading wrapped up, the pre-market sentiment for the following day, for Wednesday, was already setting a cautious tone, wasn't it? Suggesting a bit of a consolidative open after that massive Dow move.
Yeah, definitely a pause. The capital flows were holding back, waiting for the next round of reports. Stock futures were notably muted,
Right.
suggesting the market was just pausing for breath before the next wave of earnings hit. For example, the December S&P 500 E-mini futures were down a tiny 0.04%. Nasdaq futures also slightly lower.
But the Dow futures held up.
Interestingly, yes. Dow futures showed slight carryover strength, trading up about 0.64% in early activity, signaling maybe those industrial and value themes were expected to continue to attract some capital.
Okay. Let's pivot now to the significant after-hours movers. Because these moves are often based on very company-specific news and positioning, they can give us these little micro-level clues that sometimes predict broader sentiment.
Definitely worth watching. The top after-hours gainer was the spirits maker Brown-Forman, ticker BFB. It jumped 5.25%.
5.25%. What was the catalyst?
A big, unequivocal vote of confidence from management.
The company announced a new $400 million share repurchase authorization.
Ah, the buyback signal. That's management signaling two things, right? One, they think the stock is undervalued.
Yep.
And two, that they have robust excess cash flow, which is exactly what investors want to hear in a rising rate environment where capital might be constrained.
Couldn't have said it better. Buybacks are a powerful tool to generate earnings per share growth, even if top-line revenue growth is maybe slowing down a bit.
We also saw an interesting anticipatory gainer that raised some eyebrows. The Hartford, HIG. It rose 4.96% with no immediate company-specific news released.
That's weird. Just buying ahead of earnings.
It looks like it. This movement appears to be driven by aggressive anticipatory buying ahead of its October 27 earnings report. Options market activity had been pointing to unusually high implied volatility, meaning traders were betting on a huge price swing, and it seems many opted to buy in early to try and capture that expected upside.
Got it. On the losing side, we had Stryker SYK, the medical device maker, falling 2.67%. Why the dip there, especially given the general market strength earlier?
Our sources suggest this was pretty classic profit-taking. Stryker had been performing exceptionally well recently,
Right.
which placed the stock in what traders call an overbought technical condition. When a stock is technically extended like that, any slight apprehension in this case, maybe some lingering concerns over previously flagged potential margin pressures in its guidance, can trigger a wave of selling.
Especially from technical traders locking in gains.
Exactly. Locking in those gains.
And then there was SLB, formerly Schlumberger, the oilfield services giant. It fell 2.63% after hours. That was a continued negative reaction to its recent Q3 report, wasn't it?
Yeah, the problem here was really about geography. While their international activity remained strong, the CEO gave some pretty downbeat forward guidance specific to North American drilling activity.
Ah, North America specifically.
They're not expecting a significant pickup there. And since the U.S. shale patch is such a volatile and rapidly evolving market, any negative commentary on a key segment like that tends to trigger continued selling pressure, even if results elsewhere globally were strong. Investors just saw North America as a potential drag on future growth.
Makes sense. Okay, the evening's main focus, however, the big one everyone was watching, is the Netflix Spotlight. This was the most anticipated report scheduled after the Tuesday close. Tech giants like this often signal a trend. What were the market's highest priority questions for their report, beyond just the headline numbers?
Expectations were extremely high for Netflix, NFLX. Consensus estimates pointed to an EPS of $6.94 and revenue of $11.51 billion. That would represent significant year-over-year growth.
Big numbers.
Big numbers. But the market has really moved beyond just looking at subscriber numbers alone.
Yeah, it sounds like the focus was less on the top-line figures and much more on the qualitative story, the success of those new monetization strategies.
Absolutely. The market's focus was laser sharp on commentary regarding the success of the ad-supported tier and the execution of the password sharing crackdown.
Right, the two big initiatives.
Exactly. Analysts believe the advertising engine is beginning to hum, and investors are looking for concrete evidence that these new, presumably high-margin revenue streams are accelerating growth and improving overall operating margins.
Especially as the streaming market matures and content spending stays intense.
Precisely. If Netflix can prove this path to profitability works effectively, it provides a massive potential tailwind for the broader tech sector. It could potentially help the Nasdaq shake off some of its CPI-related anxiety.
Interesting. And looking forward, we have a very dense earnings calendar for the rest of the week, don't we? That will ultimately determine sector leadership and whether this rotation theme persists.
Yeah, Wednesday is critical. We shift back to big tech and autos with reports from Tesla, TSLA, and IBM.
Tesla's margins will be key.
Heavily scrutinized, yeah, for margin impact from delivery numbers. Then Thursday brings Intel, INTC, and Ford Motor, F. So that covers semiconductors, a vital sector for the whole economy, and another major auto player to compare against GM's success.
Right.
And the week wraps up Friday with the consumer products giant Procter & Gamble PG. These companies, collectively, will tell us whether the corporate resilience we saw Tuesday is a deep-seated trend or just an isolated moment.
Okay, we've talked repeatedly about this information famine caused by the government shutdown. It's starved the market of official economic data for weeks now. And this structural void is why Friday's upcoming report isn't just important, it feels paramount.
That amplification effect just cannot be overstated.
Mm.
When the market receives high-impact data after weeks of relying purely on sentiment and corporate talk,
The reaction could be huge.
the reaction is likely to be disproportionately large. Since we have no retail sales, no factory orders, no anchor, the single data point that really matters now is the Consumer Price Index, the CPI, scheduled for release on Friday, October 24, covering the month of September.
Let's nail down the expectations for this pivotal report. What are the numbers the market is bracing for, and what makes them so sensitive right now?
Okay, market consensus expects year-over-year core CPI growth. That's the measure stripping out volatile food and energy prices of 3.1%.
3.1% core.
And total CPI growth also expected at 3.1%. Now, the previous month's total CPI was 2.9%, so the expected number actually represents an acceleration in price increases.
Ooh, an acceleration. Not what the Fed wants to see.
Not at all. And critically, 3.1% remains stubbornly above the Federal Reserve's long-term 2% target. That's where the real tension lies.
Okay, this sets up the critical conflict we mentioned, the Federal Reserve dilemma. We established earlier that the market, based on that low 10-year yield of 3.96%, is already aggressively pricing in rate cuts this year.
Exactly. This is the biggest vulnerability in the entire market structure right now. Investors are currently operating under the assumption that the Fed will initiate 2 more rate cuts by year-end.
That's the bet.
That's the bet. Based on the belief that inflation is trending down enough to allow accommodation, that assumption is what has supported valuations and kept that 10-year yield so low.
But a strong, high inflation print on Friday would just directly challenge the whole rationale for those rate cuts, wouldn't it? If CPI at 3.1% or worse comes in even higher.
Then the narrative of inflation solved completely collapses.
Right.
That's the entire story right there. A hot CPI number would instantly and dramatically narrow the scope for rate cuts. If that core assumption of Fed accommodation is challenged, we will see a rapid and significant repricing across all risk assets. The sequence is pretty clear. Treasury yields would spike upward, reflecting the market realizing cuts aren't coming.
Rates go up.
Rates go up. And that higher discount rate would trigger a rapid sell-off in equities, especially hitting those rate-sensitive tech and growth stocks that rely entirely on low discount rates for their future valuations.
So the Nasdaq gets hit hardest.
Most likely, yes. The rotation into value stocks, which led the Dow to its record high, suddenly looks less like a thematic shift and more like a tactical defensive hedge against this exact outcome.
Wow. It's a huge bet the market is making then, essentially betting on the macro slowing down enough to justify cuts, even while the corporations are telling us the micro is accelerating.
It is a profound disconnect, a
Yeah.
real tension. Now, before we wrap up, we should probably quickly touch on the global context and geopolitical factors that provided a bit of a positive backdrop for Tuesday, even if they weren't the main drivers of the Dow's moves.
Good idea. We saw improved sentiment regarding U.S.-China tensions, right?
Yeah, President Trump softened his stance a bit on potential tariffs. He said a previously threatened 100% tariff on Chinese imports was not sustainable.
Okay.
That comment served as a vital piece of de-escalation, easing those trade war fears and providing some general support for risk assets globally.
Every little bit helps, I guess.
Right. We also noted the unusual timing of the symbolic Diwali Muhurat trading session in Indian markets. It was held in the afternoon. It's a symbolic session marking the beginning of the new Hindu financial year.
Interesting.
Just underscores the ongoing interest and growing importance of Asian markets in the global picture.
And looking further afield, analysts are pointing to Japan as maybe an attractive opportunity for international diversification.
Yeah, that's popping up more. With the country appearing to finally move past decades of deflation, a combination of newly attractive valuations and ongoing corporate governance reforms is making Japanese equities look potentially compelling for foreign investment.
So another alternative for capital looking to maybe flee potential volatility in the U.S. market.
Exactly. Another place to potentially park money if things get choppy here.
Yeah.
Hashtag outro.
So what does all this mean for you, the listener? Tuesday, October 21st, it was a clear and decisive win for corporate fundamentals. No doubt about it. Strong earnings led the Dow Jones Industrial Average to a record high.
Yep.
But the narrow leadership, the fact that the Dow surged while the Nasdaq paused it, really shows that this current wave of optimism is highly selective.
Very selective.
The rally feels like it's built on an island of proven corporate performance, not necessarily a broad tide of economic confidence.
That's the perfect synthesis, I think. The market is navigating a truly precarious path right now. It's aggressively rallying on the hope of Federal Reserve easing and rate cuts, while simultaneously staring down the barrel of official inflation data on Friday that could aggressively undermine the very rationale for that hope. The reaction to that expected 3.1% inflation number, whatever it turns out to be, will be the ultimate test of the market's current resilience. It'll separate the true believers from the tactical hedgers.
The stakes just couldn't be higher. The market is celebrating the known strengths of publicly traded companies, General Motors, Coca-Cola companies that just delivered excellent quarterly reports and raised guidance. Great news.
Known knowns.
Known knowns. But you now know the potential unknown risks. Stress may be brewing in those opaque private credit markets, which could trigger a sudden institutional flight from risk.
The dark alley problem.
Exactly. And the single amplified data point of Friday's CPI, magnified by that government shutdown data void.
It creates a fascinating philosophical test, really, for how you view the economy's true health right now.
Indeed. So our final provocative thought for you today is this. Given the extensive information vacuum we're in, which driver, is it the corporate guidance proving robust pricing power and demand? Or is it the single delayed high-impact inflation data that could shatter rate expectations? Which one will ultimately prove to be the more reliable indicator of the economy's true health? And think about which sector value, driven by known earnings or growth, dependent on future capital costs, is best positioned for that outcome, and why.
That's where the real thinking and the real trading decisions begin.
We'll see you next time on The Deep Dive.